Auntie Patricia, are you there?
Yes, please, I'm here.
Okay. I hope you are doing well.
Yes, please.
Okay. Question number
Question,
3.
okay. Question 3. The draft financial statement of Barbary Cement Limited, BCL, for the year ended 31st December 2022 include a plant having a carrying value of 400 million Ghana cedis. Due to technological change, the remaining useful life of the plant has been reduced to 4 years. The following information has been gathered for impairment testing of the plant. Inflows from sale of products to be manufactured by the plant for the year 2021 are estimated at 200 million Ghana cedis. These inflows are subject to 10% decrease in each subsequent year due to declining demand. Outflow from operational costs for 2021 are estimated at 80 million Ghana cedis. These outflow would increase by 5% each subsequent year despite decline in demand due to inflation and increase in plant wear and tear. BCL's net profit is subject to income tax of 20%. Depreciation on plant is calculated using straight line method. The plant's net disposal proceeds at the end of the useful life is estimated at 100 million Ghana cedis. Pre-tax and post-tax discount rates are 12% and 9.6% per annum respectively. A technological advanced plant with similar capacity can be purchased at 350 million Ghana cedis. BCL has received an offer to buy the existing plant for 250 million Ghana cedis. BCL will have to incur shipping costs of 7 million Ghana cedis to dispatch the existing plant to the purchaser. Required, complete the impairment loss to be recognized as at 31st December 2020.
All right. So this we know that if you want to calculate impairment, we need to know our carrying value and also our recoverable amounts at the date of the impairment test. Okay. The date of the impairment test over here is 31 December 2020, and we are given the carrying value already. The carrying value is 400 million. We need to find our recoverable amounts, which is the higher of the value in use and also the higher of the value in use or the net realizable value. Okay, all the information given to you over here, they are given to you for the purpose of computing value in use. But you can see that your net realizable value can be determined easily over here as 250 minus the cost to sell of 7 million. Okay, so that is the net realizable value. But how do we determine our value in use? Value in use, we use the pre-tax cash flows together with the pre-tax discount rates. Okay, so the pre-tax cash flow is what we are going to be using. Pre-tax cash flow with pre-tax discount rates. Okay, so how do we determine the pre-tax cash flow? You are given the cash inflows that will be coming and cash outflows that will be coming. Okay, we are not going to be charging tax, so tax benefits on depreciation should be ignored. This is just like financial management question. This is about determining your cash flow. But financial management will determine after tax cash flow. So we look at the impact of the tax on the depreciation. But this one we are using pre-tax what? Cash flow. So since we are not going to be paying tax on the cash flow, it means that depreciation should be ignored because depreciation is a non-cash item. So let's come to our pre-tax cash flow schedule. Let's prepare that first. So let's know our. So we have our. So question number 3. Okay. Question number 3. So we know our carrying value at the date of the impairments. We are given our carrying value to be 400 million. Okay, we know our net realizable value to be 250 minus 70. So the company has received offer. The company has received offer. Please, this one is just a replacement cost. The technological advancement plants with similar capacity can be purchased at 350. Okay, this is a replacement cost, unless the question is telling you that use replacement cost for, but we use a net realizable value. So BCL has received an offer to buy the existing plant for 250 million. BCL will have to incur shipping costs of this to dispatch the existing plant to the purchaser. So 250 minus 7 million, that will be the net realizable value. So 250 minus 7, that will give us 243. So we need to calculate our value in use. How do we calculate our value in use? That is what we are coming to do. So the value in use, we look at the pre-tax cash flow. So let's do it the years. Let's do it years. Okay. So we have year 1, year 2, year 3, and year 4. Because the useful life of the machine is now reduced to 4 years. So we look at the benefit over the 4 years. Okay. So these 4 years will start from, place the value in use to be the present value of the future cash flows. Future cash flows should start from a year after the impairment. So we are doing this on 31 December 2020. Cash flows that we are going to be using should be starting from 2021, December 2021. That is a year after the impairment test. We look at the present value of the future cash flows. The future cash flow should be arising a year from what? From the date of the impairment. That will be, if you are doing it 2021, should be, you use 2022 cash flows. If you are doing it 2022, you use 2023 cash flows. The cash flow should be starting from 2023. So that is why they are giving you cash flows from 2021. That is a year from what? 2020. So if you don't want to do it year 1, year 2, you can just name your year 2021, 2022, 2023, and 2024. So let me do it like that so that for purpose of revision, you can actually, so 2023 and 2024. Okay, let's count to cash, let's count to the inflows. 2024, what will be 2021? What is the inflow that they are talking about there? The inflow is how much? Inflow from sale of product to be manufactured by the plant for the year 2021 are estimated at what? 200 million. Okay, so we have our 200 million. Okay, so what will happen in 2022? What are they saying there? These inflows are subject to 10% decrease in each subsequent year due to declining demand. So what will be the inflows in 2022?
That will be 180.
Okay. So that will be 180. Okay. 2023 will be what?
It will be 180 minus 10% of 180.
Okay, that will give us what? Just find 90% of each year's cash flow.
162.
I'm having
162.
Okay.
162.
2024 will be 90% of that. 145.8. I hope we are okay with that. Okay. Let's count to, this is the sales. We are going to be incurring cost. So you will sell, but you incur cost before selling. So we have the operational cost. Then we will be having the operational cost there. So let's have the operational cost. What are the operational costs? So the operational cost, outflows from the operational cost for 2021 are estimated at 18 million. this outflow will increase by 5% each subsequent year, despite decline in demand due to inflation and increase in plant wear and what? Yeah. Okay. So let's come to the outflows. These are all cash. So, okay. So we come to outflow, which is a cost that we are going to be incurring. Okay. So okay. So the first 2021 is 80. So you subtract the 80 from this. Okay. 2022 what? Will increase by 5%. What are you going to be getting?
84.
80.
4.
That will be 84. Okay. So we have our 84. Okay. Then we have the 84. What will be the year, the other year? I'm having
88.2.
88.2. 88.2. Okay. Then we have the other one will be
92.61.
okay, 92.61. 92.61. Okay. So what will be our net inflows? This will be 120.
96.
This will be 96. 160 minus 88.2. I'm having 73.8.
The last one is 53.19.
53.1. Okay. Please, we use pre-tax cash flows, so forget about the impact of depreciation. Okay, we are not paying tax on the what? On the cash inflows. We use pre-tax cash inflows, so the depreciation will not be what? Will not be considered for tax purposes because we are not paying tax on the cash flow, so ignore the depreciation. Okay, but if we are using after tax cash flow, then it means that we have to bring in the impact of the depreciation, like how we do it under financial management. But this one we are using pre-tax cash flows. So what are the cash flows before we now pay tax on it? Since we are not paying tax, depreciation will not be allowable for tax purposes. But let's come here. There will be an outflow. There will be an inflow. Who can identify the inflow for me? There will be an inflow. This is not important. This is not important because we are using pre-tax cash flow. So depreciation will also not be important. Okay. Let's come to, there is an inflow here. Whenever we are doing the present value, we use an inflow at the end of the what? At the end of the useful life, which is what?
The scrap value.
The scrap value.
Yeah.
So the scrap value will also be an inflow. So you can bring the scrap value. That will be inflow. So dash. This will be 100, isn't it? Okay. The last year will be 100. So we can have that will be 100. So we can add total our amounts, or if you like, you can just include 100 over here as the what? As the inflows. So you can say inflows including the scrap value. So you'll be having 245.8 over here. So let's have our 120 here, our 96 over here, our 73.8 here. Then this will now give us 153.19. So these are cash flows. These are our cash flows now, pre-tax cash flow. We can now go to discount them. Okay, so we now discount them. The discount factor will be pre-tax discount rate because since we are using pre-tax cash flow, we also use the pre-tax what? Discount rate. The pre-tax discount rate will be what?
12.
Okay,
12%.
so let's find the discount factor for all of them. The first year, which is year one, what will be the discount factor for year one?
0.892.
Okay, so we have 0.892. Year two will give us what? Is it 893 or 2? Should be to 3 days.
89.
Okay. 0.8928. So 3 decimal place will be 0.893.
Okay. Year 2 is 0.797.
Okay, 0.797. Okay. And
0.712.
0.712. The last year,
0.636.
0.636. Okay. So what will be the first year will be what? 120 multiplied by the cash flow, 120 multiplied by the discount factor. What are we having?
107.16.
107.16. The second year will give us what? 96 multiplied by
76.51.
okay. 76.51. Okay, the third year, 73.8 multiplied by 73.8 multiplied by
52.55.
52.55. 52.55. And the last year, which will be
97.43.
97.43. Okay, what will be our total cash flow? What will be the value in use? The total of our, this one will give us how much?
$333.65.
So we have 333.65. So between the value in use and net realizable value, which of them are we going to be taking as a recoverable amount?
Net recoverable.
Which of them are we picking as a recoverable?
The lower.
Are you sure?
The value in use.
Okay, so we pick the highest.
Okay, the value, the highest we submit it.
Okay. So we pick the higher of any of the two. So you will see you are not going to sell the asset because the value that you are going to be receiving is lower than the benefit that you'll be getting. So you continue using the asset. So our impairment loss will now be our 400 million, which is a carrying value, minus 333.65. Okay, how much will be the impairment loss?
$66.35.
Okay, 66.35. So that is it. It's not anything big. All right. So compute the impairment loss to be recognized as at 31 December 2020. That would be 66.35. Nothing. The only thing is how to calculate the cash flow. That is how to calculate the value you use. That is the only issue about this particular question. Apart from that, nothing else. All right. So let's come to question number 5, which is on earnings per share.
Question 5.
No.
The following information relating to ChatGTP CL has been gathered for the purpose of calculating earnings per share. Profit after tax for the year ended 31st December 2022 and 2023 amounted to 308 million and 280 million respectively. 25 million ordinary shares, each with a par value of 10 Ghana cedis, were outstanding as at 1st January 2022. On 1st April 2022, 2 million convertible bonds with a par value of 100 cedis each were issued, carrying interest at a rate of 18% per annum, payable on 31st March each year. Every 2 bonds are convertible into 3 ordinary shares after 5 years. On 1st January 2023, 6 million 16% cumulative irredeemable preference shares, each with a par value of 50 cedis, were issued. Every preference share is convertible into 2 ordinary shares after 4 years. On 1st May 2023, CL announced 40% rights issue to its ordinary shareholders at 45 cedis per share. The entitlement date for the issue was 1st June 2023. The market price per share immediately before the announcement date and entitlement date was 65 cedis and 80 cedis respectively. Required: compute CL's basic and diluted earnings per share to be disclosed in CL's financial statements for the year ended 31st December 2022. Sir, please go ahead. And B, 31st December 2023, along with comparative figures.
Okay, thank you. All right, so we take December 2022 first. Let's take December 2022 first and look at the issues there that are in December, that are under the consideration or under the 2022 year. Okay. Okay. So let's come to, so let's identify the, so we are looking for basic and diluted earnings per share. So let's come to 20, that will be question number 5. We look at the basic earnings per share. How do we calculate basic earnings per share? It's calculated as profit was attributable to ordinary shareholders or ordinary, let's say ordinary earnings or profits, okay, divided by our weighted average number of what? Shares. So we do this for 20, we do this for 20, we do this for 2022. Okay, so we do this for 2022. Okay, so what is the profit for 2022? Profit for the year?
308.
Okay, 308. 308. Were there any irredeemable preference shares for the year 2022? Irredeemable preference shares. Were there any irredeemable preference shares for 2022, or were there any new issue of shares for 2022?
No.
Okay. So the only thing that we are going to be having is there are 25 million shares, isn't it?
Yes.
Okay. So we have our 308. There was no new issue of shares. That will be 308 divided by the 25 million shares. Okay, 25 million shares. So we have 308 million divided by 25 million shares. Okay. What is the value that we are getting?
$12.32.
12.32. Okay, so we have 12.32 per share. Okay, 12.32 per share. So they are asking us for diluted earnings per share. Okay, so we need to do the diluted earnings per share for that year also. So diluted earnings per share for this year also. So diluted earnings per share, that will be 2022. How do we calculate this? It will be our ordinary shares there. So our ordinary earnings, which let's say profit after tax, plus the notional
Profit.
profit or interest divided by our existing weighted
One plus
average
notional.
plus the notional amount. The diluted earnings per share is just that, okay, what are the potential items that are going to be affecting our earnings per share in the future? What are some items that, if they are likely to be converted into equity shares, or what are some items in the future when they are being converted into equity shares, they are going to be having impact on our earnings per share. So let's assume that these instruments are being converted today. What will be the impact on our current earnings per share? That will always be convertible instruments and also share options. The one that we have over here is the convertible instrument. So we have a convertible instrument on 1st April 2022. Okay. 2 million convertible bonds with a par value of 100 each were issued. The bonds carry interest at a rate, okay, at a rate of 18% per annum, payable on 31 March each year. Every 2 bonds are convertible into 3 ordinary shares after 5 years. Okay, so let's come here. These bonds were issued at 1st April 2022. Okay, the reporting date is what? 31 December 2022. Okay, so assuming we are converting this particular instrument this year, what would be the interest? What is the interest on this particular instrument? What is the interest that we pay this year? Okay, what is the interest that has been paid this year? Okay, what is the interest that has been paid this year? So we have the interest on that particular amount. The interest will be 18% multiplied by the amount. What is the value of the bonds? What will be the total value of the bonds? We are issuing 2 million at 100 cedis. So what will be the total value? Would that be 200 million?
Yeah.
Okay, so we have 0.18 multiplied by 200 million. But we pay interest for how many months?
From April to 9 months.
That will be 9 months. So we have 9/12. So what is the interest that has been paid?
$27.
27. Okay, 27 million. Okay, if you pay interest, the interest will be allowable for tax purposes, isn't it?
Yeah.
Okay, so currently, what is our tax benefit on this interest? You are going to pay interest of 27 to the holders, but the tax authority will give you tax allowance on that. Are we giving our tax rate? Do you have tax rate in the question?
No.
We're supposed to give you tax rate. Okay, let's use a tax rate of 30%. Okay, let's use a tax rate of 30%. We should have a tax rate there. Okay, so let's use a tax rate of 30%. What would be the benefit that the tax benefit that we'll be getting?
Eight.
8.1.
Okay, so that will be 8.1. Okay, so if you are converting these to equity shares now, if you are converting these to equity shares now, you are not going to be paying the interest again because these people will now be equity holders, equity shareholders. So you won't pay the interest of 27 million again. But what will happen? You'll be losing a tax benefit of what? 8.1.
8.1.
So what will be if you are not paying the interest, if these people you are converting their instrument to equity shares, you'll be saving what? 27 million as the interest, but you also be losing a tax benefit of 8.1. Okay, so what will be the net savings from converting those people to equity shares? That will be the interest and the
70%.
tax that you'll be losing. So that will give us how much?
18.9.
18.9.
Okay, so what we
So
do is that,
is it the same as the 70% of that?
yes, what we normally do is the tax, we just find after tax benefits, which is 70% of the interest that you are paying. Okay, because these people, you are subtracting their interest from your profit before charging tax. Now if they are equity shares, it means that the interest will not be subtracted again. So you'll be paying tax of 30% on their interest. So just find 70% of that. So if we are converting this, we are going to be having, so our diluted earnings per share, the top will now be the current earnings of 308 plus the savings that we'll be having, 308 plus 18.9. Then we come to the down. Our number of shares will be the existing 125 million plus the shares that we are going to be getting from converting these people. But we do this one pro rata. Since we are prorating the interest, the shares will also be prorated. So let's come to let's convert their shares. What are we having? So they have 2 million. Okay. They have 2 million convertible bonds, but they are saying that every 2 bonds are convertible into what? 3 ordinary shares after 5 years. So we have 2 million. 2 million. We have 2 million currently. Okay, we have 2 million. We have 2 million. The number of bonds that we have. The number of bonds that we have will be, the number of bonds that we have will be 2 million. Okay, but they are saying that every 2 bonds will be converted for 3 shares. Okay, so the question now is bring 2 bonds for 3 shares, and we have 2 million bonds. So what we do is that if 2 is equal to 3, then 2 million will be equal to what? Or you can do your 2/3 multiplied by the number of bonds that you have. What are we going to be getting for the number of shares that we are going to be giving to them? So number of shares will be equal to 2/3 multiplied by 2 million bonds. What are we getting?
One, three.
Okay, 1,333. Okay, so let's have 2 million.
Won't we time apportion it?
Yeah, we time apportion that 2 million over 2 multiplied by 3. Are you sure? Let me check that again. We have 2 million for, no, 2 million for every 3. That should not be the distance. Check again. If 2 is equal to 3, okay, how many will be equal to that? I'm sure that will be 3/2 multiplied by 2.
That's a bonus fraction.
Okay, so this time this 2 is equal to 3. How many will be this one? It will be 3 multiplied by 2 and this one. So that will give us, okay, that will give us 3 million. Okay, there are 3 million shares. What we do is that this will have only 9 months effect because the interest has been prorated. If you don't prorate the interest, if the interest is no time apportion, then you also leave the shares like that. Okay, so since we prorate the interest, this will, if we convert it today, it will have only what 9 months effect on our profit. Okay, so this is supposed to be 3/2 multiplied by 2 million, not 2/3, because we are bringing 2 million for 3. So how many 2 are in the 2 million? That will be 1 multiplied by the 3. That will give us 3 million. What are we having? 3 multiplied by 9/12.
$2.25.
2.25. Okay. All right. You have to do a particular test before you calculate that. Okay. So let's check whether this particular instrument is dilutive. How do we check that? We do
Use the nominal interest over
18 points
the nominal share.
divided by 2.25. What are we getting?
8.4.
Okay, is the 8.4 lower or higher than the current earnings per share?
It's lower.
Okay, so if it is lower, it means that this instrument
It's
is
dilutive.
Okay, sometimes it will be higher than that one. You ignore because it will not have any effect on our current earnings per share. Okay, so let's have this. So 308 plus 18.9. I'm having 326.9 divided by 27.25. So what will be our diluted earnings per share?
$11.996.
Okay, if you are approximating to 2 decimal places, it will be 12.
Yes.
Okay, so 12 cedis per share. That is our diluted earnings per share for the first year, which is the 2022. So that is what we are going to be doing for that particular year. But let's count to 20.
So you said we should make it 12, right?
Yes, make it 12. If you are approximating to 2 decimal places, the 6 will make the 9, 10, and that will have effect on the other one too. That will be 12. Okay, so that is for the first year, which is 2022. Let's count to 2023. Okay, 2023, this is what will happen. Okay. 2023, let's look at the issues in 2023 and we look at it. So the basic earnings per share, we have our profit of 280. Okay. Our shares will still be 25 million because there was no bonus issue, there was no right issue in the subsequent year. Our convertible instrument is always used when we want to calculate what? Diluted earnings per share. So this has no effect on what? The current earnings per share. The current earnings per share is calculated on what? The shares in issue now, the existing shares. This convertible instrument will be converted in the future, so it has no effect. It will not be included in calculating our basic earnings per share. But the question is, if these things should be converted today, what will be the effect? So they are always used for calculating diluted earnings per share. But let's come here. On 1st January 2023, what happened? 16% cumulative irredeemable preference shares, each with a par value of 50 million were issued. Every preference shares is converted into 2 ordinary shares after 4 years. This is also going to be, if you want to calculate your earnings per share, this will be having, or this will be taken into consideration when calculating our diluted earnings per share because it's convertible. But currently what will happen is that we are going to be paying dividends on the what? Irredeemable what? Preference shares. Please forget about the cumulative since it is irredeemable. Since it is irredeemable, what will happen is that we are not going to be redeeming it. So this will be treated as equity. It will be treated like equity. So the dividend on it will be equity. Forget about the cumulative. All redeemable preference shares, if you are not able to pay their dividends, you will still pay the dividends in the next year. So all irredeemable preference shares, their dividends are cumulative. If I'm not redeeming the shares, it doesn't mean that if you don't pay dividend this year, you will not pay that particular dividend to me the next year. You accumulate it and pay it to me. But just that I will not what? Convert, or I will not ask you to what? To give me the shares back or give me my money back for the shares, or I will not be selling my shares. I will not redeem it. I will not count for, or you will not buy the shares back. It will be with the company forever. So that will also be treated as if it is equity instrument. So their dividend, we have to calculate their dividend over here and take it from the profit after the tax because that has not been taken. Their dividend is not treated as a finance cost under financial instruments. Their dividends are treated as if they are equity dividends. They are treated in a statement of changes in equity. So if you are looking for the profit, it means that the profit that is attributable to the ordinary shareholders, we have to take the portion of the dividend that is for the accumulative or cumulative irredeemable what? Preference shares. Just forget about the cumulative. The major factor over there will be irredeemable. I'm giving you 200, I won't come for the money back. Okay, I won't say pay my money back. But if you are supposed to pay interest, it doesn't mean that if you don't pay interest for this year, you will not pay that particular year interest to me in the what? In the future. You will cumulate it and pay it to me. But just that I won't count for, you don't have any cash obligation to pay this amount at a future date. And that is making it to be what? Equity. They are going to stay with the company forever. That is making them to behave like their equity shares. So your earnings attributable to the preference shareholders over here. So let me just make it very simple. Our basic earnings per share for this year will be 280 minus preference dividends. How do we calculate the preference dividends? It will be their percentage rate multiplied by the amount that we are receiving from them. So we are issuing 6 million at 50. So the amount will be 30 million or 300 million. So we are having 6 million shares. 6 million shares multiplied by 50. I'm having 300 million. Okay, then we find 16% on that. That would be their dividends. So we have into bracket 0.16 multiplied by 300 million. What are we having? So
48.
okay, so divided by our weighted average number of shares. So we have to come and calculate our weighted average number of shares now. Okay. So there was a right issue. There was a right issue. Okay. Okay, there was issue about right issue there. That is there. So on 1st May 2020, CL announced what? 40% right issue to each ordinary shareholders at 45 per share. The entitlement date for the issue was 1st June 2023. The market price per share immediately before the announcement date and the entitlement date was 65 and 80 respectively. Please, what date are we going to be using? What date are we going to be using? Will that be a 1st May or that will be 1st June? And why?
We're going to use the 80 cedis.
I'm interested in the date, not for now, not the, if we know the date that we are going to be using, then we know.
I think 2023.
No, they have to
You know, we're
here.
going to use the 1st
June.
June.
We are going to be using
The
June.
June.
okay. Why not 1st May?
It was announced on 1st May, but then I would say it was put into action in June.
Okay.
It was in June the market price was determined.
Or we have market price for all of them. Okay, so we have 65 and 80 respectively. It was announced on 1st May, isn't it?
Yes,
But it will be effective from what?
1st June.
1st June.
Okay, so if I'm saying that in 2 months time, I'll give you 20 Ghana cedis. In 2 months time, I'll give you 20 Ghana cedis. Does it mean that if I give you the 20 Ghana cedis in 2 months time, that is the time that the money will be effective?
Yes.
What about the promised date?
What about?
What about the promised date? The date that I'm saying that I'm going to give you.
No, you've given a tentative date, so I can't come to you for the money before your
Okay.
the last date that you stated in the.
Okay. Okay. So you use the entitlement date. Okay. So the entitlement date will be the 1st June 2023. Okay, this was just an announcement. The amount has not, the items or the shares has not been given to you yet. So the shares will be effective from the time that you are actually giving the shares. Okay, we can announce the dividends and the dividends will never be paid. Okay, we just announce, okay, we are going to be paying 40% dividend today. You cannot just rely on that particular announcement and say that these people are owing you. No, the dividend has not been declared. We just announced that we might be paying dividends or we'll be paying dividends of this. From the board meeting, board of directors can decide to say no, looking at the profit, we cannot pay this dividend. So that will never be approved. Okay, so you get this from the allotment date, which will be the time that you'll be giving the shares. So that will be 1st June 2023. So the 45 is determined in advance. The 45 will be effective from the 1st June 2023. So we know that bonus issue will always come with, right issue will come with an element of bonus issue. Is that correct? Right issue will come with a bonus issue and also a full market value. The right issue, you are going to be receiving portion as cash and portion will be at what? Portion will be at bonus. So let's now look at the number of shares that we are having. So let's have the existing shares. Okay. So the existing shares will be 25 million. Is that correct? Okay.
Yes.
We are giving them 40% of this amount. So what will be the shares given to them? If you are giving them 40% of this, what will be the shares that we'll be getting from the
10.
okay, that will be 10. Okay. Can we find the proportion of the bonus issue? Okay, if we cannot find it, this is how you are going to be getting. So what percentage? So let's do 245. Okay, can we say the right issue proportion is 245? Check that. 245.
Let's see the
Yeah,
question.
yeah, you can do that.
Okay. 245. So
Yeah.
bring every 5 for 2. Okay. But if you cannot determine the proportion, please just calculate your theoretical XY price using the total values. Okay, so I'll doing the theoretical price. So just 2/5 multiplied by 25, that will give you 10, which is the right issue. But if you cannot do that, you always have to calculate what we call the theoretical XY price. So we have to calculate our theoretical XY price. How do we calculate that? We just find our value of the existing shares. Our existing shares will be 25 million trading at what? At the date of the entitlement. What is the value for them?
80.
That was 80, isn't it?
Yeah.
Okay. So multiply by 80. What will be the total amount?
2,000.
Okay, that will be 2,000. Then we come to the right issue. How many shares are we giving to them under the right issue? That was 10 million at a price of what? 45, isn't it? At a price of 45.
450.
Okay, 450. Okay, so what will be the total here? 2450. And the number of shares over here will be what?
35.
35 million. Okay, so we want to find our number of our value of a share now. Okay, value of a share, which is what we call the value per share, which is what we call a theoretical extra price. Okay, so now we know that the total value of our shares after the right issue will be 2450. But what is the number of shares that is giving us this value? It is 35 shares. So the value of a share or the market value per share will give us the total value divided by the number of shares that we have. So that will be 2450 divided by 35. What are we having? We're having
70.
70. Okay.
Yeah.
2450 divided by 35. So that will give us 70. Okay. So the shares should be issued at what? 70, isn't it? Okay.
Yeah.
But this shares has been issued at 45, isn't it?
Yeah.
Okay. So the amount that you are receiving from the shares is what? Is 45, which is the market value. But you are giving the shares to them at 70. So if you are receiving 45 from them, it means that you are utilizing your retained earnings to cover the remaining one of 25, isn't it? Is that correct? The shares have been given to them at 70. Okay. The shares should have been issued at 70. Okay. But how much did you receive from them from the right issue? 45. We have received 45 Ghana cedis from them, isn't it?
Yeah.
Okay. But the shares are actually 70. So where are we getting the 25 from?
It's from the retaining.
Okay. So you just find the bonus issue, the shares for the bonus issue, and you find the shares for the market value. So the bonus issue will be 25/70 multiplied by the total number of shares that we are giving to them as right issue. Our market value, the shares issued at the market value, will be calculated as the 45 over 70 multiplied by 10. What is what we are getting over here?
$6.43.
So 25 over 70 multiplied by 10. I'm having 3.57 for the first one.
Yeah.
Okay, 3.57. And this one will give us what?
6.43.
6 points.
43.
Okay. So if you are coming here, you see that bonus issue, the bonus issue will be on the existing shares, and the existing shares will be for what? A full what? 12 months. So you can just come here and add your bonus issue of 3.57. Okay. And you get your, this will be there for bonus issue will be assumed to be issued from the time that the existing shares were there. So you count your full market value. So what were the shares that are issued at market value? That will be from June to December, 1st June to December. So this will be having 6.43 multiplied by June to December is how many months?
7
It's
months.
Okay, so you do times 7 over 12. That will give you, so this will be 28.57. I will show you another way of doing this. And you also have 6.43 multiplied by that. 6.43 multiplied by 7 over 12. I'm getting 3.75. Okay. So if you add, you have 28.57. I'm having 32.32. Okay. This is another way of doing this. You find your right issue fraction, which will be your share price immediately before the right issue or the entitlement. Okay. So you have your fraction, the right issue fraction, that will give you 80 divided by 70. Okay, then you count your weighted average number of shares. Okay, so you count to the existing shares. So you apply the percentage, the fraction on the shares that have been issued before the right issue. So that will be 25 million multiplied by 80 over 70. What are you getting?
28.57.
Okay, 28.57. Okay, but the shares, how much was the shares before you are getting 28.57? It was 25 million, isn't it?
Yeah.
So this has increased by 3.57. So this 3.57 is representing the bonus issue. But the total shares that you are issuing is 10 million. So if bonus issue is 3.57, what percentage will be for the, or what will be the number of shares for the full market value? It will be 6.43. And the full market value will have effect from the time that the right issue is done. That will be from 1st June to 31 December. That will be 7 months. Okay, the shares that are coming in for a value at a market value, they will have effect on the profit from the time that they have been issued. But the bonus issue will be assumed to be in existence from the time that the existing shares have been there. So the bonus issue will have effect from the beginning of the year, or for the time that the shares that are affected by the bonus issue, they will have effect from that date. So this will be having a full year. So you count to the full market value, you have your 6.43 multiplied by the 7 over 12. Or another way of doing this is that you ask yourself, okay, before the right issue, before the right issue, the existing shares will do how many months? The right issue was done on 1st June. Before the right issue, the existing shares will do how many months?
5 months. 5
Okay.
months.
So you do multiply by 5/12. So the bonus issue will affect the existing shares. So 5/12. Then you now come to your shares from June to December, 1st June to December. That will be 7 months. But as at this time, what will be our total number of shares? It will be 25 plus the right issue. That will give us 35. Okay. Multiply by 7/12. Okay, what are we getting? From June, our total number of shares will be 25, which is the existing shares, plus the bonus issue, the right issue of 10 million. That will give us 35, and this will do 7 months. Okay, so 25.
20.4142.
Okay. So 5/12. I'm having 833 for the first one. 833.33. Is that correct?
The second one, 20.416.
20.
0.417.
Okay.
It's 20.4166666. So 20.417.
Okay.
So the first one is 11.9.
11.9.
Yes.
So 20 points. Can we make this one 20.42?
Yeah.
42. Okay.
Okay. And the first one is what? So I'm the one.
11. Yes.
Okay. Divided by 70. Okay. Multiplied by 5 divided by 12. So 11.90. Is that correct?
Yes, please.
Okay. So if you add it to what are you having?
32.32.
Okay. So any of them that you have to, but I always prefer you sharing the full market value will have the effect from the date of the issue. So if you do that, that will be okay. So our weighted average number of shares now will be 3.32 here. Okay. So let's find our earnings per share. So we have 0.16 multiplied by 300 minus 280. I'm having 232 here divided by 32.32. What are we having?
$7.18.
Okay. So 7.18 per share. But they are asking us to do diluted earnings per share. Okay. Diluted earnings per share. So we have the diluted earnings per share. So let's come to the diluted earnings per share. Earnings per share. The diluted earnings per share will just be the existing items that we have over there. So we have 3.
Times the bonus fraction.
So 232 plus the benefit that will be coming here. Okay, the benefit that will be coming here divided by our 32.32. These are our existing figures. But let's count to what is going to be happening. Okay, we have 2 convertible instruments now, isn't it? Okay. In 2023, the convertible bonds will now be doing a full year, isn't it? The convertible bonds will now be doing a full year. Okay. The convertible bonds will now be doing a full year. So they will now be doing a full year. So if they are doing a full year, the interest will be 27 million on it. Is that correct? No,
Yes.
it will not be 27. 9 months is the 27. Okay.
Okay, the full year. Okay.
Okay. So the full year, let's find the full year interest. Okay. Let's find the interest on that. The interest will be 0.0 0.18 multiplied by 200. 0.18 multiplied by 200. Would that be 36?
Yes.
Okay, so what will be after tax benefits? After tax benefits. We are using 13%, so that will be 0.7 multiplied by 36. How much are we getting?
Is that how much? What percentage are we using?
30. We use 30 first. So let's maintain a 30.
Yeah, 30% will give you 10.8.
Now let's just find 70% on it. Okay.
0.7.
2.
That will be
25.2.
25.2.
okay. So we have 25.2. So that is the interest that we are going to be saving from this place. So 25.2. So if the shares are being converted, if the bonds are converted, our number of shares will be 3/2 multiplied by the 2.5 million. That will give us 3 million shares. Are we okay with that? Okay. So this will increase by 3 million shares. Okay, that is from the convertible instruments. But let's come to our preference shares too. They say every preference shares is convertible into what? 2 ordinary shares after 4 years. So if the individual preference shares are also converted, okay, it means that we are not going to be paying the dividend to them again, isn't it?
Yeah.
Okay, the dividend is how much for them? The dividend was 0.16 multiplied by 300. How much was that?
Point 13. Hello?
Yeah, the dividend
Is it
was
0.13?
0.16. Okay, before you even include the figures, let's check whether they are dilutive before we include this figure. So let's check if the convertible instrument will be dilutive. So let's look at this. That will be how to calculate this will be
25.2.
25. So let's check whether they are going to be dilutive will be their interest that we are receiving 25.2 divided by 3 million. What are we getting?
8.4
8.4. But what is our
compared
current,
to any
what is,
any
what,
person.
what is our current earnings per share?
7.18.
Okay. So it means that this is having 8.4. This is higher than what our current earnings per share. Though this will be declared to be non-dilutive. So we now include it. So you check to see if it is dilutive or not. It will be dilutive when your interest that you are having now, your interest savings is actually your interest savings over the number of shares is giving you a value lower than the current earnings per share. If that is the case, we say that that is what? Anti-dilutive. That is dilutive. If it is lower, if this value should be lower than 7.17, then it means that it is going to reduce our earnings per share in the future. So that is dilutive. But if it is higher,
So 2023, the basic was 7.12, 7.117, right?
yeah, it was 7.18, yeah. So this will be anti-dilutive or non-dilutive. So let's come to the preference shares. So let's have the preference shares. Please don't just add, check whether it will be dilutive or not. So the preference shares, we are going to be having a dividend. Okay, dividend of 0.16 multiplied by 300. How much are we having? I'm having 48.
Yes, 48.
Okay, please, dividends is paid out of profit. So there is no tax issue on the what? On the dividend. So we are going to be saving all the 48 because it's paid out of what? After tax profit. So there's no tax benefit on this. Okay, let's count to if they are converting their preference shares to ordinary shares. what will be the number of shares that they are going to be having? Okay, so there's 6 million, and every preference share is convertible into 2 ordinary shares. They say every share.
1/2.
Okay, so every share, 1 share will be equal to what? 1 preference share is equal to what? 2 ordinary shares. So if you have 6 million, how many ordinary shares?
Have 300.
No, every preference share is
Not 12 million.
that will be 12 million.
If more, less divide.
Okay.
Oh, okay.
So give me 1 preference share for 2 ordinary shares. So if you have 6 million, that will be 6 multiplied by 2. So that we have 12 million. So let's check whether this is dilutive. Okay. So what will be the benefit that will give us? So let's check whether this is dilutive. That will be 48 divided by 12. What are we having? Would that be 4? Okay. But you can see that the 4 now is lower than what? Our current earnings per share. So this is dilutive. We come here, add a 48, then we add our 12 million shares to them. Okay. So we have 280 over here divided by 44.32. What are we having? I'm having 6.32 per share.
6.32.
Okay, so you can see that it's actually lower than what? The previous figure. They say you should show comparative. Okay, the comparative is just that, okay, the bonus issue is going to be affecting the 2022 figure. The bonus issue will affect the 2022 figure. So for you to show the comparative, this is how you show it. We know that the bonus issue supposed to be, the bonus issue was 3.57. Where did you get a bonus issue? Okay, the bonus issue was 3.57. Bonus issue was 3.57. Where did we get? I calculated the bonus issue. Okay, 3.57. So we can recalculate our earnings per share for the last year. That would have been earnings per share for the last year would have been 308. 308. So that would have been basic earnings per share for last year would have been 308 divided by 25 plus 3.57. Okay, which is 308 divided by 28.57. What are we having? The bonus issue will affect the existing shares at the
10.78.
10.78. Okay, this 10.78 you can calculate it like this. So you can just look at your basic earnings per share for 2022. You pick the figure that the basic earnings per share for that particular year. Okay, so what is the basic earnings per share for 2022? That was
12.32.
okay, 12.32. So this 12.32 you multiply by the reciprocal of the bonus, the right issue fraction, which was 80 over 70. You change it now
70.
to be 70 over 80. What are you getting? You'll be getting 10.7.
10.78.
Okay. All right. You also have to look at the impact of the diluted earnings per share. Okay. So the diluted earnings per share to our value over here, our value would have been, this would have been plus 3.75, this would have been something. It would have been 27.25. So you can also do the diluted earnings per share, which will be 12.0 multiplied by 70 over 80. They are going to be having the same effect. Okay, so 12 multiplied by 70 over 80. I'm having 10.5. That is the cumulative. This will be the cumulative figures. You show the effect of the bonus issue or the right issue on your previous calculations. That is the cumulative. So this is how we show the cumulative. Okay. Right now it's 6 o'clock. Let's take the revenue questions. Question 10. Angie Batisha, are you there?
Please, I'm here on question 10.
Yeah.
Financial statements of Trick MIR Limited for the year ended 31st December 2019 are under preparation. While reviewing revenues from contracts with customers, following matters have been identified. A. 1st September 2019, TML sold Machine C to Chan Limited for 25 million. As per the contract, payment would be made after 2 years. The accountant recognized sales revenue of 25 million upon delivery on 1st October 2019. Further commission paid to sales employees for winning the contract of 1.6 million was capitalized and is being amortized over 2 years period. Applicable discount rate is 10% per annum.
Okay.
B.
Okay. Should we take it one by one? Let's do the first one, then we come to the second one. Okay. All right. If you are, we are saying that we can only recognize revenue when risks and possession ownership associated with the goods has been transferred to the customer, isn't it?
Yeah.
Okay. We have given the goods to the customer on 1st October 2019, isn't it? Okay.
Mm-hmm.
But we are asking him to pay after 2 years. How much is he paying after 2 years? How much is the customer paying after 2 years?
$25 million.
Okay. So if the customer should have cash and pay today, will he be paying the 25 million?
No.
Okay. So whenever sales are being done, goods has been delivered, and the person will be asked to pay at a later date. The sales is including a financing component. What do we call a financing component? We have taken into consideration a time value of money here. So we have to find the actual revenue. The actual revenue means if the person should have cash today, how much would the person be paying to us? That is the actual revenue. So what we do is that we always present value the future payment using 10%. So we have to find the revenue for this particular one. So question number 10, you have to find the sales revenue at 1st October. So if the person should have cash and pay, the person will not be paying the 25 million today. So that will be October 2019. So what you do is that you discount the 25 million, which will be 25 divided by 1.1 exponent 2. Okay. So find the present value of the 25. So that will be 25 divided by So 25 divided by 1.1 exponent 2, because this will be paid in 2 years' time, and our discount rate is what? 10%. So how much are you getting as a current sales revenue?
$20.66.
Okay, 20 points. Okay, so at October 2019, these are the entries that the company will pass. People are owing now, so you debit receivables. Okay, you debit receivables of 20.66. Okay, then you credit revenue of what? 20.66. So whenever there was a sales, goods has been given to the customer, but the customer will be asked to pay a certain amount at a later date. It means that if the person should have cash and pay, the person will not be paying that amount. So we have included what? A finance component together with the sales revenue. So since you are going to be holding our money for a particular number of time, you have to pay interest on it. So the interest has been added to the actual sales revenue to get the amount that the person will be paying. So how do we find the sales revenue? We just find the present value of the future amount that the person will be paying. So that is be the 20.66. And the reporting date is 31 December, isn't it?
Yes.
Okay. So 31 December 2019. So what will happen over here is that we have recognized the revenue already, but what will happen? The person has to pay interest for how many months? From October, 1st October to 20.
3 months.
Okay, so the person, they have to pay interest of 3 months. So we are going to be having a finance income of 0.1 multiplied by the present value, which is 26 multiplied by 3 over 12. Okay, that will give us how much?
$0.52.
Okay, so they have to pay interest of 0.52. So this will be taken to your profit or loss as finance income, but this will be, the company will be having receivables of this amount in their books. It will be the current amount plus the interest that the people will be paying. Okay, so we increase our receivables by the interest. The revenue should always be the present value of the what? Of the future cash flow. Then you will now be charging the finance component. So what is the interest element? You'll be recognizing the interest element as finance income to your statement of what? Profit or loss, and you'll be adding the same figure to your revenue, because you have to get 25 million at the end of the year. So 0.52 plus 20.66. So
21.18.
so they will now be owing you 21.18. Okay, these are the, for financial reporting, these are the side of the issue that they will be examining you on. Sales can be made today, goods will be given to the person, and the person will be asked to pay at a later date. If that happens, it means that there is a financing component in the what? In the amount. So we separate the portion that is for the revenue and the portion that is for the interest that the person has to pay because of keeping our money. The revenue is the present value of the future payment, and the difference between the two will give you the interest component. Okay, there can be a time also the person will pay, but the goods will not be given to the person. So you have made a deposit and the goods are here to be delivered to you. So since the goods are here to be delivered to the person, the money given to the company by the person will be treated as a loan. So the company will just charge interest on the loan up to the amount, up to the time that the goods have been delivered to the person. So the customer can make advance deposits, and the customer is here to receive the goods. So it means that the person is giving you advance payment. That advance payment will be treated as a loan, which you are going to be charging interest on that. So you always have to pay attention to that. The person can pay, but the goods will be delivered later. since you have that money now, treat the money as a loan. Okay, treat the amount as a loan. But you can sell to the person will pay at a future date. You are going to recognize revenue, but the revenue should be recognized as the present value of the future cash flows. Then you'll be unwinding your receivables every year to get your finance component. So this is what they have to do. They are talking about what? Commission. They are talking about commission. Okay. We call something incremental cost if we count to IFRS 15. How do we account for the incremental cost? Okay. There are situations where you have, okay, there are situations where you are negotiating a contract. Okay. So you take car and go there. So you incur a transport of 200. Okay. If the contract is not what? Is not secured, you have already incurred a transport cost, isn't it? You are negotiating a
Yeah.
contract and you have to go to the customer's premises every day. So you are going to be taking transport. So even if the contract is secured or not secured, the transport cost will be incurred. Okay. So there are certain costs that you are going to be incurring before the contract will be what? Will be awarded. Those costs are treated as a research cost. They are just treated like how we treat research costs. They are costs that you are going to be incurring regardless of the outcome of the what? Of the contract. But there are certain costs that you are going to be incurring after you have secured the contract. That cost will be a commission that you are paying to the people that worked on the contract. So that is a cost that is incremental to the contract. So if those costs are incurred, which we call the incremental cost, those costs that are incurred after the contract has been secured, mostly it is the commission. The standard says that those incremental costs should be capitalized as what? As contract assets and amortized over the contract period. So these people are going to be paying over 2 years. So just amortize, just capitalize your contract cost of 1.6 and now what? Amortize it over the 2 years. Okay. And they have actually done that. So they don't have any problem with that. So since the people are going to be taking 2 years to pay, then we have to what? We have to also spread the cost over 2 years. But if the people have paid already and we have given the people commission, since the contract has already been what? Has already been delivered, the commission cost will be expensed as well. But if it is going to take some years before the contract will be delivered or the people will be paying, then you can reasonably what? Amortize that particular one over the number of years that it will be taking the people to pay. But if the contract has been delivered and the people have paid already, the commission will be treated as a normal commission. Okay, so further commission paid to sales employees for winning the contract of 1.6 was capitalized and is being amortized over 2 years. Applicable discount rate is 10%. So although the contract has been delivered already, but these people are going to be taking 2 years. Okay, these people are going to be taking 2 years. So we can say that, okay, since they are going to be they are going to be taking 2 years to pay, then this cost we incurred has to be spread on the amount that we are receiving from these people over the what? Over the 2 years. But if the contract is delivered immediately and the people have also paid, it means that the contract has no years again. So the commission will be taken to profit or loss as a normal commission. Okay, so let's come to the B part.
B.
Oh.
ML entered into a contract to manufacture a specialized machine for Dan Limited at a price of 30 million. The contract meets the criteria of recognition of revenue over time. At the year end, the machine was 60% complete and it was estimated that further cost of 10 million will be incurred. Cost of 50 million Ghana cedis incurred till year end has been included in closing inventory, and receipts of 11 million have been credited to the revenues.
Okay. Okay, that is cool. Okay. So let's come here. You see, we have construction contract, mostly construction contracts. It's those people that will be building the houses. Okay, if I'm a contractor and you are asking me to construct a story building for you, if I'm done with the first floor or the ground floor, you can say that, okay, since you are done with this one, we are going to be moving in. You can move in with your family whilst I'll be working on the top. So those are what we call performance will be satisfied over time. So I will come and do portion of the work. The work that I've done, you have to give me money. I will take revenue for that one. Then the next day I will come and do this work again. Okay. So what they are saying now is that, assuming you are giving me a work, you are giving me a work. Okay. So let's come here. This is construction contract. We use two methods. We use the input method and the output method. How do we use that? We use that to determine the portion of the work that is completed. What is the total cost that I'll be incurring to complete the work? What is the total cost that I'll be incurring?
$30 million.
No, the contract price is 30 million. But what is the cost?
25.
That will be 25. Okay. It was estimated that further cost of 10 million will be incurred. But as of today, I've incurred a cost of 15 million. So the total cost I will incur is the cost I've incurred already plus the cost I'll be incurring again. So the total cost of this particular contract is what? Is 25 million. Okay. So if the total cost is 25 million, if the total cost is 25 million, it means that if I'm able to incur a cost of 25 million, it means that the work is done, 100% complete, isn't it?
So why are you paying it at 25? Because they say 30 and the additional 15.
Read again.
$30 was a contract sum, and they estimated 10, but they ended up using 15.
No, they say a further cost of 10 million will be incurred. Cost of 15 million incurred till year end has been what? Included in closing interest, closing
Oh,
event
okay.
and receipt
Okay.
of 1
Okay.
million have been credited to revenues. So we
Okay.
have incurred 15 million already. We are estimating a further 10 million cost. Okay,
Okay.
total cost to complete this contract will be 25 million. But we have entered into a contract to manufacture a specialized machine for Dan Limited at a price of 30 million. That is the amount that we are charging. That is the contract price.
Yeah. I've seen it.
Okay. So if you are able to incur a cost of 25 million on the contract, it means that the work is 100% complete, isn't it?
Yes.
Okay. But what is the cost incurred now? It's 15 million. So what portion of the work that we have done to get a 15 million? You can find the corresponding
That's
one,
the 60%.
and that is the 60%. So if you are using cost, to determine the work complete, we look at what we call input method. So you look at the cost that you are going to be incurring. What is the total cost that you are going to be incurring? You are going to be incurring a total cost of what? 25 million. But you have now spent 15 million. So what percentage of the work that is completed with the 15 million? So we do 15 over 25 multiplied by 100. And that is the 60% that they have given to you. Sometimes they will not tell you, they will not give you the percentage, but they will give you what? What is the portion of the work, the cost that they have incurred, and the total cost to complete the work. You always have to know that, okay, if you want to get a revenue of 30 million, you have to incur a cost of 25 million. So for you to get a revenue of 30 million, you have to incur a cost of 25 million. Now you have incurred a cost of what? 15 million. So what will be the portion of the revenue that is representing the 15% cost? It's the same as you find the percentage of the work complete multiplied by the 30. Or you can also find the total profit on the contract. What will be the profit that we are going to be getting from the contract? Our contract price is 30 million. Our total cost is 25 million. What will be the profit?
5 million.
Okay, 5 million. This profit can be, before you have to get this profit, you have to incur a cost of what? 25 million, isn't it?
Yes.
Okay, so if you have incurred 15 million now, what portion of the profit will be equivalent to the 15 million? So we'll be looking at that. So how do we account for this? the entity has to recognize a revenue. Revenue has to be recognized in proportion of the work done. That will be 15 over 25 multiplied by 30 million. You have to incur a cost of 25 million to be able to receive all the what 30 million, but you have incurred a cost of 15 million. So what is the portion of the revenue that is relating to that? That will be 60% multiplied by the 80, which is 15 over 25 multiplied by the 30. So 15 over 25 multiplied by 30. How much are we getting?
18 million.
18 million. So what will be the cost of sales? What is the cost that we have incurred on this?
15 million.
Okay, the 15 million, or you can also do 15 over 25 multiplied by the 25. That will give you 15 million. Okay, so you'll be having a profit of 3 million. Okay, so if you are using the input method, we also have output method. The output method, we use the what? The revenue that we have to recognize. The question will always give you the work satisfied. The work satisfied by a professional. So they will come and look at the work and say, okay, the work that is completed is this one. So this is the amount that you can get. So if you are telling me that the selling price for the work done is this, so what will be the percentage of the work completed? So I will do the percentage of the revenue that I'll be getting from the work satisfied divided by total revenue multiplied by 100. That is what we use output method. So we use revenue to determine the percentage of the work done. So you only recognize revenue to the percentage of the work done. So we are going to be recognizing 18 million in our revenue and 15 million in cost of sales. So we have a net profit of 3 million. The question is saying that has been included in closing inventory and receipt of 11 million have been credited to revenues. Okay, so what should happen? The 15 million should not be in closing inventory. So you will now go, let's correct this. Okay, we are going to be correcting this. Revenue should be 18 million, isn't it? So we increase revenue by additional 7 million. Is that correct? $11 million has been credited to
Yes,
revenue.
it was 11.
Okay, so we increase revenue by the 7 million. We decrease inventory by what? Decrease inventory by the 15 million should not be in inventory. It should be in cost of sales. So we decrease inventory by 15 million and we increase cost of sales. Okay, cost of sales by 15 million. So we go and remove the 15 million from inventory and add it to cost of sales. Okay, how much was received? What is the total amount that you're supposed to receive from the customer? You have incurred a cost of 15 million and there's a profit of 3 million on the contract. What's supposed to be the total amount that you have to receive?
18.
Okay, so we look at what we call contract assets. Okay, the contract asset is calculated as cost incurred to date, cost incurred to date, and the cost incurred to date is the 15 million. Okay, plus the profit or loss on the contract. Sometimes you make a loss. The loss will be treated as onerous it will be treated as a liability, which is onerous contract. It means that you have to incur additional cost to complete the contract. So you have to make provision for the additional cost that you'll be incurring. So that will be treated as onerous contract. But profit will be 3 million. So I've done the work for you. I've incurred a cost of 15 million and I'll be taking a profit of what, 3 million. So you're supposed to pay me 18 million. But how much was received? How much?
15.
We have no. Look at the receipt. The receipt is there. Has been. And receipt
is
of
there?
11 million. Receipt of
Oh.
11 million has been credited to. So these people have paid us what? They have paid only what? 11 million.
11.
So they will be owing us how much?
7.
Okay, that 7 is what we call the contract assets. So you can see that we debit cost of sales, credit inventory with 1515. We credit inventory, we now have to debit what we call the contract assets. Okay, so this is how we go about it. So this is how the company should account for this transaction, apart from what they have done. What they have done is not the correct treatment. Okay, let's come to the C.
C. CML Limited entered into a contract to sell 1 unit of machine A and machine B for a total price of 16 million. Machine A was delivered in December 2019 to the customer, while machine B was delivered in January 2020. The consideration of 16 million is due only after CML transfers both the machines to the customer. CML sells A and B at standalone prices of 12 million and 8 million respectively. The accountants recognized receivables and revenue of 12 million upon delivery of machine A. Explain the relevant computation, the treatment of the above transactions in financial statement CML for the year ended 31st December 2019 in accordance with IFRS 15, revenue from contracts with customers.
Okay, so this one, yeah, please go check the YouTube channel. There's a video on revenue from contracts. You are going to see it in your exam. Look at it. It's very simplified and you can get everything over there. It is part 1 and 2. So check that. But these are the important areas that the question can come from for you. Okay, we call something sales at a discount. Okay, you can see now the company is selling machine A and B for an amount of what?
60 million.
Okay, but if these machines should be sold separately, they will be sold for a total amount of what?
12 and 8, 20.
Okay, but we are selling for what? 60 million. It means that we are giving a discount of what?
4 million.
4 million. So we want to know what portion of the discount will be for machine A and what portion of the discount will be for machine B. What we do is that we share, we know that 20 will give us the, if we want to get this one, the 20 is the 16. So 12 will be how much? So what we do is that we just share the amounts. So this amount, if we have to be full, if we have to be selling for full, it will be 20 million. 20 million, machine A will take 12, the other one will take 8. Now we are having 16. So what portion of the 16 is for machine A? We share it based on their respective selling price. That's what we do to share the amount that we are receiving from the total amount. But you have to take notice of this. Okay, machine A, our reporting date is 31 December 2019. Okay, and the company has entered into a contract to deliver the machine for this year. But what happened is that it's only one machine that has been delivered to the customer. So we have sold only one machine. The customer has possession of only one machine. The machine B are still with us. We cannot recognize revenue relating to machine B because the machine has not been sold. The machines are still in our possession. They have not been sold. Okay, let's ask ourselves. The machine A was delivered in December 2019 to the customer, while machine B was delivered in January 2020. The consideration of 16 million is due only after TM transfers both the machines to the customer. TM sells machines A and B at a standard loan price or standalone price, prices of 12 million and 8 million respectively. The accountant recognized receivable and revenue of 12 million upon delivery of machine A. No, the contract is 16 million. Okay, so you are automatically going to deliver the machine B and you'll be receiving 16 million. So since we are going to be selling the two machines, we cannot recognize the revenue of 12 million. You automatically deliver the machine, the second machine. So what we do is that, okay, assuming these two machines have been delivered, what will be the prices for each of them? So we look at their prices. Okay, their prices, we look at their prices. So we look at the total contract price. The total contract price was 16 million. Okay, but if this item should be sold at their separate values, our total value as a standalone, will be 20, isn't it? Okay, so we find the revenue portion for machine A. So we do it for machine A. So machine A will be 12 over 20 multiplied by 16. Am I correct? Machine B will be 8 over 20 multiplied by 16. Is that correct?
Yes.
Okay, so what will be the revenue that will be recognized for machine A?
9
We recognize for machine,
9.8.
okay, so that will be 9.8. So we recognize will be 9.8. So what do we do? It means that we have to go and decrease the revenue by a certain amount. So we recognize this one and also recognize a corresponding receivables. So recognize a corresponding receivables. Receivables, because these people are owing us corresponding receivables of 9.8. So what we do is that they have recognized revenue of 9.8. They have recognized revenue of 12 million and also receivables.
Sir, is it 9.6 or 9.2?
12 divided by 20 multiplied by 6.
9.6.
Okay, I'm having 9.6.
9.6, sorry.
Okay. So 9.6. So what you do is you have to go and adjust your revenue. So this entry will now be, you will now debit revenue of how much? They are recognized 12 million. So 12 minus 9.6. That will give us what? 2.4. Okay, then you credit receivables. So you now have the transactions 12 minus 9.6. And that will give us 2.4. Okay. So yes, these are the, you either sell on credit and the person will be paying later, financing component. You either sell at a discount, which is this one. Okay, so you can see that there's a discount of 2.4 on the sale of what? The machine A, and there will be a discount of 1.6 on the sale of machine B. The discount has been adjusted already. That's why we are taking 9.6 to profit or loss. Okay, but if you want to show the discount as a separate item, that means that you show the revenue at 12 million, then you bring the discounts of the 2.4. That will be having effect of 9.6 as the revenue. Okay, so
Cyrus,
yes, Miriam.
why is it receivable?
The people are here to pay. You are only receiving the money after the delivery of the second machine.
I was thinking it's a revenue is recognized as a point in time. So I don't know. Are we actually recognizing the machine B2?
We are not doing anything about machine B. We are concerning about the transaction that has been done for machine A. Machine B is still with the company.
Okay, I get it.
Huh?
I get it now, sorry.
Okay. Let's take the last question, which is question number 11 on the on Okay, let me see whether I can take the question number 11 and 16. So that's okay. 11. Effect of foreign exchange transactions.
Question 11.
Yeah.
Brain Della acquired an equipment supplier on credit for $6 million on 31st March 2022, when the exchange rate was $1 to 5 cedis. The entity incurred other direct costs of 1.5 million Ghana cedis in installing the equipment. The estimated useful life of the equipment is 10 years, and the entity has obligation to restore the location to its original state after usage. The estimated cost of dismantling and restoration in 10 years is 3.5 million Ghana cedis, and the entity's cost of capital is 8%. Although the equipment was available for use from 1st May 2022, the entity did not bring it into use until 1st July 2022. Brain Della also sold goods to a foreign customer for $3.5 million on 30th April 2022, when the exchange rate was $1 to 5.75 Ghana cedis. The customer paid $1 million on 1st July, when the rates were $1 to $1 is equal to 5.6 Ghana cedis. On that date, Brain Della paid half of the amount owed for the equipment. At the entity's year-end of 31st December 2022, the closing exchange rate was $1 is to 5.9 Ghana cedis. The entity's functional currency is the Ghana cedis. Required, explain with relevant calculations how the above transactions should be accounted for. Show extracts in the financial statement at 31st December 2022.
Okay. So this is about PPE and also foreign exchange transactions. Okay. The company acquired what? An equipment from a foreign supplier on credit for 6 million on 31st March. So 31st March, let's record this transaction. So 31st March, let's record this transaction. So question number 11, 31st March. So what will be the entry that will be passing for this on 31st March? What will be the entries? We are buying equipment. What will be the entries on credit?
We debit the equipment and credit.
And we credit to our payables, isn't it?
Yeah.
So we have debit equipment. So what will be the amount that we are going to, we are reporting in Ghana City. So that will be 6 multiplied by 5. Am I correct?
5 point something, or the exchange rate
It's 5. It's 5 at that date.
at the beginning. Okay.
So that will be 5 multiplied by 6. That will be 30 million. Okay. So in Ghana City, that will be 30 million in Ghana City. Okay. And the payables will be, we have credit payables. Okay. The payables in our books will be also 30 million at that date. Okay. But let's determine the cost of the equipment, total cost of the equipment, the initial cost of the equipment. So cost of the equipment, we have some other issues over here which has to be taken into consideration. So the cost of the equipment, we are going to be having a purchase price of 30 million. Okay. They are saying that direct cost has been incurred, isn't it? The entity incurred other direct costs of 1.5 million in installing the equipment. So that is a cost to bring the assets ready for use. So we have installation cost of 1.5. We also have dismantling cost, isn't it? So the dismantling cost will also be discounted and be added. How much are we spending in the estimated cost of dismantling and restoration in 10 years' time is 3.5 million, and the entity cost of capital is 8%. So you discount this 3.5 multiplied by 1 over 1.08 exponent 10. How much are we getting?
$1.62.
1.62. So dismantling cost will be 1.62. Okay, I don't have space there. So let me count this one with the dismantling cost. So I have 3.5. This will be paid in 10 years' time, divided by 1.08 exponent 10. So let me just clean this. Yeah. Yeah. Okay. So I have 1.62, isn't it? Okay. What will be the total cost of the machine?
$33.12.
Okay. So we have 33.12. Okay. So let's focus on the machine and then the provision. We're also going to be having a provision for dismantling cost. Provision for dismantling cost at the start of the date will be, the provision will be 1.62. Okay. The equipment will be depreciated. Let's look at when the depreciation will start. Okay. Although the equipment was available for use from 1st May 2022, the entity did not bring it into use until 1st July 2022. When does depreciation start on assets? When does depreciation?
When it's available for use.
Okay, so the depreciation will start from 1st May. Okay, so we have 3.2 divided by 10 years, multiplied by how many months? May to
May is 8/12.
8/12. Okay. So
You don't first May?
yes, 1st May. Okay, that will be 8/12. Okay, that will give us how much?
$2.208.
Okay, 2.208. We have to calculate finance cost on what? On the provision. So that will be 0.08 multiplied by 1.62 multiplied by what? That will not be a full year. Okay, it will be for some months. Okay, so how many months? How many months? The finance cost will be calculated for how many months?
From which period to which period? Then we know the month.
I didn't give you, let's just say the company, the estimated useful life of the equipment is 10 years, and the entity has obligation to restore the location to its original state after usage. The estimated cost of dismantling and restoration in 10 years is 3.5 million, and the entity cost of capital is 8%. Although the equipment was available for use from 1st May 2022, the entity
Then
did not
it's
bring
the same 8/12.
Okay. So the unwinding starts from the time that you put the machine or the machine is available for use. It will be done in a proportion of the depreciation. What are we having? 0.08 multiplied by 1.62 multiplied by 8 divided by 12. I'm having
So-
0.0864.
864, yeah.
Okay. So this is about the provision and depreciation. Let's come to the issue of the trade payables, which is still remaining there. Okay. Let's come to the payables. Let's deal with the payables first. Okay. The payables was 6 million. So let's have Brendela also sold goods to a foreign customer for 3.5 million on 30th April when the exchange rate was 1 cedi is to 5.75. Okay. So let's bring that sales and also, so we are going to be on 30th April. We are going to be having sales on credit 2020. Okay. So we now have our receivables. So that is on credit. So we have receivables. That will give us how much? That will be 3.5 multiplied by 5.75. Is that correct? Multiplied by 5.75. What are we getting?
20.125.
Okay, 20.125. So we have 20.125, and we are going to be crediting revenue. Okay, the revenue will also be 3.5 multiplied by 5.75, 20.125. Okay, that is the amount that we have for the receivables also. So we are going to be having payables and also receivables. The customer paid 1 million on 1st July when the rate were what? 1 cedi is to what? 5.65. Okay, so let's come with the customer now. Okay, so the person has paid 1 million. So I'll show you the way that you can go about this. So we have the balance on the receivables, the balance on the receivables, on the total receivables will be 20.125. Okay. You can calculate this one like this. Okay. You'll be calculating the amount that the customer is paying. Okay. How much is the customer paying? The customer is settling what? 1 million at 5.60. Okay. So the customer payment is, the customer is paying 1 million. So we have 1 million multiplied by 5.60. That will give us 5.60. Okay, come here. The customer is paying 5.60. But that 1 million that the customer is paying, what was the value of the 1 million in our books? What was the value of the 1 million in our books? The equivalent 1 million in our books was 1 million multiplied by 5.75. Is that correct? The equivalent 1 million in our books is what? 1 million multiplied by 5.75. I hope
Yeah.
that's correct. Okay.
Yeah.
Okay. So the person is supposed to pay 5.75, all things being equal, but the person has paid what? 5.60. What is happening there?
We lost
Okay, there's exchange loss of how much?
15.
Okay.
0.15.
Okay.
0.5.
Okay.
Okay.
0.15. Okay. You have so many ways of doing this, so let me just give you all the options so that you can use all of them. Okay. So if the customer has now paid 1 million, what will be the balance? What will be our balance at the end of the year? We need to find our balance at the end of the year. We are going to be having our start or at the beginning, the time that this transaction was done, the value was 20.125, but the person has made a payment of that. So cash received. So we come to cash received. Okay. Or balance settled. Let's come to this place and say balance settled. Okay. The balance settled, the person has paid in relation to the 5.75. Is that correct? 5.75 should be taken away from this because the receivables balance included over here is 5.75. So let's take this one away. How much are you going to be having? I'm having 14.375. Is that correct?
Yes.
Okay. So what will be the closing balance now for our receivables? Our closing balance, the person is now owing us how much in dollar? The customer will be owing us how much in dollar now? Would that be 2.5? Would that be 2.5 in dollar? It was 3.5, they settled 1 million. So the outstanding balance in dollars now
2.5.
will be 2.5 at an exchange rate of how much? At a close.
5.9.
Okay. So we have 5.9. Okay. How much are we getting?
14.75.
14.75. That's supposed to be the closing balance. So there's a gain over here, isn't it? Okay. The gain is how much? $0.375. Is that correct?
Yes, please.
Okay. So what will be the actual gain? We have a loss on the receivables also, which is 0.15. So we have a loss of 0. So the net gain on the receivable.
0.225.
Okay, the net gain on receivables will be 0.375 minus 0.15. So that will give us
0.225.
0.225. So this is what we take to profit or loss as the net gain. Let's come to the other around this one. Let's see this. I know Brother Philip will say that why not this one? We are looking for ticks. Okay, so that is the issue. So let's come here. Let's have the other way around this and see whether we can get the same figure. So we have our receivables, which will be balanced at start. The balance at start was 20.125. Okay, then you just bring the amount that has been received. So we have cash received. Okay, our cash received was 5.60. So this will be reducing your receivables by 5.60. What will be the amount remaining? I'm having 14.525. Is that correct?
Yes, sir.
Okay. So you come to your closing balance. You know that the person will be owing you. The person will be owing you 2.5 multiplied by 5.90. That will give you 14.75. So your supposed balance should be 14.525. Now it's 14.75. That will be a gain of how much? 14.75 minus 14.525.
0.225.
Okay, 0.225. Okay. So you just you just reduce your receivables by the amount that you have received from the customer. Then the first loss of 15 will be what will be reflected in the overall gain of this one. But you can also show it one by one. What is the loss
Very
that
simple.
you are having on the settlements? Okay, let's come to the issue of the payables. Okay, so the payables, what is the outstanding balance? Okay, our standing balance is what? It's 30 million. Okay. So we have our standing balance of 30 million. So let's see the settlement. Let me try the second one for you. So let's see the settlement. How much did we pay? How much was paid? Okay, Brain Dela had paid half of the amount owed for the equipment. Okay, and the customer paid 1 million on 1st July, and the same date, half of the payables has been paid. So we paid 2.5, we paid 3 million at 5.6. So we are going to be paying 3 million, which is half multiplied by 5.6. How much is remaining? Or how much are we paying? 3 multiplied by 5.6. I'm having 16.8. Is that correct?
Yes.
Okay, so we're supposed to have a balance of 13.2. Let's come to the closing balance. We try the two and see whether you get the same answer. So we have 13.2. That 13.2, at the end of the year, our remaining balance will be settled at, if we're supposed to pay, will be settled as 5.90. So 3 multiplied by 5.90. What are we having?
17.
Okay, 17.7. So this is payable, so that will be a loss. So we have a loss on the transaction of how much?
$4.5.
Okay, so you have a loss of 4.5. Let's go and check whether the 4.5 will be the same as you doing it one by one. Okay, so the 3 million that we are paying, the half that we are paying is actually 15 million Ghana cedis, isn't it? The 3 million that we pay, which is half, it was 15 million in our books. Okay, we have now paid 16.8, isn't it? There will be a loss of 1.8 from the settlements because the 3 million was first recognized at 5 cedis. So that will be 15. By the time that you are paying 60 pesos in excess. Okay, so the 60 multiplied by the 3 million that you are paying, you have a loss of this. Okay. Then if you come here, your supposed balance supposed to be 30 million minus 15 that was settled. So we have 15. Then the 15 will now be against the 17.7. That will give us additional loss of 2.7. So you put the two loss together, I'm sure you'll be getting the 4.5. Okay, so you pick the one that you are comfortable with, and that is it. So depreciation over here will go to profit or loss. Profit or loss. This will go to profit or loss. The loss on the receiver, this one, where do we get the loss? We have a loss of, okay, this gain will also go to profit or loss. Or you can net the two. You can net the gain of 0.225 against the loss of this one. Then you have the net exchange rate loss of the difference. So that also go to profit or loss. But this will go to statement of financial position. This will also go to statement of financial position for the current year. Our equipment will be shown as the cost minus this figure. Our provision, we are going to be adding the finance cost to the provision and send that one to statement of financial position. All right. Let me try the last question on provision. Then we can now okay, take the 16 for us. This one, let's see if we can do something about this.
Question 60.
Yeah.
Candle is being sued by a customer for 2 million Ghana cedis for breach of contract over a cancelled order. Candle has obtained legal opinion that there is 80% chance that Candle will lose the case. Accordingly, Candle has provided 400,000 Ghana cedis in respect of the claim. The unrecoverable legal costs of defending the action are estimated at 100,000 Ghana cedis. These have not been provided for, as the case will not go to court until next year. Required. What is the amount of provision that should be made by Candle in accordance with IAS 37 provisions, contingent liabilities, and contingent assets?
Okay. So please let's just kill this one. Okay. Kill this one without me. Okay. What's the provision supposed to be made for what amount and why? You can't just stand up and mention the amounts. No.
100,000.
They should make a provision for only 100,000. Okay.
There
Okay.
is irrecoverable legal cost.
Okay. So that one, whether they are going to be winning or losing, they cannot avoid what? The legal cost. So that one you have to set it aside. But what about the 400,000 provision that they are making?
We did
Oh,
that.
they are,
We did that
they
the 100 from it and then credit the 300 back.
Okay. Okay. So why are you saying that the provision should not be made for the 400,000?
Because of the probability of
Okay.
of they winning. They have 80% probability.
80% of winning the case. So when you are winning, you don't make provision.
Okay. Okay. All right. So thank you all for coming out.
But senior,
Yeah.
please, I asked this and you were asking me that the instruction. I saw this question somewhere and you were telling me that the instruction is that they should make,
No,
they should handle, they should deal with the issue.
no, they have that is a final account. Okay. The
Okay.
question that you sent to me is a final account what? Adjustment. Footnote. Okay. They have done a wrong thing. So you know that provision should not be made. So you have to reverse that. They have done the wrong thing. So you have to now do the correct treatment by reversing the amount that has been what? That has been credited. So they should not make a provision. Okay. They should not make a provision, and they have made a provision. So you have to now give them the correct treatment by reversing the provision and do the right thing.
Okay.
Okay. All right. Mhm. All right. This is a court case that we don't have any information about it. So we rely on our lawyers' estimate and advice. This is going to be a contingent liability because the possibility of us paying depends on the outcome of the court case. But since we are going to be engaging professionals, they will be giving us an advice that, okay, there's a 20% chance that you are going to lose the case. If I'm telling you that there is a 20% chance that you are going to be failing the exam, you have a greater possibility of what? Of passing.
Winning.
So it means that you have passed the exam already. So you cannot be making a provision for failure. You have to make a provision for jubilation. Okay. So they have 80% chance of what? Winning. The possibility of winning the case is higher than the possibility of losing. So you go for the what? The possibility of winning. So since we are winning the case, we can't make provision for any amount that we are going to be paying to what? To the customer. But for the legal cost, we cannot recover it. Whatever happened, whether we win or we lose, we have to make provision for the legal cost. So we reverse the 400,000 that has been done. Then we now bring in the 100,000. In effect, we are going to be reducing our provision by 300,000 because we need to make provision for only 100,000. So you go and credit your administrative expenses because the provision will always be in administrative expenses. You go and remove the 300,000 there. You also go to the provision in the statement of financial position. You also remove the 300,000 from the 400,000 to now have a provision for the legal cost of the 100,000. Auntie Ajua, I hope you are okay now. Okay. So seniors, this is how far we have come. We are done with financial reporting, but we are not done with life. We still meet, we still talk, and we still be on the pitch until 1st July. We'll still be talking. Okay. And after 1st July, we'll still be talking. We are always going to be talking. Okay. So thank you all for coming. I'll see you guys.
1st July be a Republic Day.
1st July, you are writing the exam.
Yeah.
It's a Republic Day. Tell the people to
It's a
postpone it.
holiday.
It's for those
No,
who are
no,
not
no.
writing the exam.
Is it holiday? It's not holiday.
No, 1st July was a holiday before, or they have scrapped that one too.
Yeah, I think they review it.
Oh, but last time 6 March they wrote exam on 6 March. This one. So that one
So we write. I don't think it's a public holiday.
no. So even if it's a public holiday, people you still write. So the holiday is for those who are not. It's opportunity cost. The holiday is for those who are not writing. So we will go out and do whatever we want to do. Okay. So yes. So that is it. We will still talk. If anything, you can always get to me. Then we see how we can go about it. I wish you all the best. Don't rely on too much information, because too much information in the system can also make you feel frustrated, and you end up not doing well in the exam. Let's try our best. At least 50 marks is the pass mark. Let's try. By God's grace, everything will be fine. All right.
Amen.
Yeah.
We also thank you so much for your effort.
Thank you, Sina. You're welcome. All right. So
All the best.
all right, Sina.